On July 6, 2026, a warning about Russia's war economy did not come from a battlefield map. It came through the banking system. According to Reuters, a European intelligence report prepared for European Union officials said Russia faces the risk of an explosive banking crisis because its banks are absorbing a growing share of the cost of the war economy. The report estimated that 10% of Russian corporate loans are doubtful. It said some major Russian banks reported retail delinquency rates as high as 15% in 2025. And it pointed to more than 500,000 Russians declaring bankruptcy in a single year. The danger is slower, quieter, and strategically more serious. Russia's banks may be acting as the invisible shock absorber of the war, taking pressure that might otherwise hit factories, regional governments, households, construction firms, and the federal budget directly. If that is true, the question is not whether every bank fails at once. The question is how much future damage has already been moved inside the financial system, where it can be hidden, restructured, delayed, and renamed. The first number is the one that changes the entire reading of the system. 10% of corporate loans classified by that European intelligence assessment as doubtful. In a normal economy, that would be alarming. In a war economy, it suggests the banks are not merely financing growth. They may be carrying policy. The official Russian counter-argument is very different. Philippe Gabunia, the deputy chairman of the Bank of Russia, said the vulnerabilities in the financial sector are not critical. He said bad corporate loans stood at 4% and had not changed over the last year and a half. The Bank of Russia's own financial stability review also presents a system that remains resilient, continues financing the economy, and has built buffers against consumer credit problems. The European intelligence report is an outside assessment by an adversarial policy environment. The Bank of Russia is the regulator of the system being assessed, and an institution with every reason to prevent panic. Neither source should be treated as gospel. But the gap between the two is the story. One side sees manageable stress, the other sees losses accumulating underneath the official surface. And the surface is exactly where banking systems can look strongest right before they are forced to admit weakness. Since the invasion of Ukraine turned into a long industrial war, the Russian state has leaned on credit as one of the quiet tools of endurance. Defense firms need financing. State-backed regional projects need financing. Home buyers need financing. Large employers that cannot be allowed to fail need financing. The federal budget cannot openly absorb every burden at once, so part of the strain moves through banks. Reuters reported that the European intelligence assessment pointed to lending to defense enterprises, state-backed regional projects, and home buyers as channels that increase the volume of credit that may never be repaid. That phrase is the core of the problem. May never be repaid. In peacetime, a bad loan is a financial mistake. In wartime, it can become a political decision. A bank may prefer to restructure. A regulator may prefer to soften provisioning rules. A state may prefer to keep a debtor alive because the debtor employs thousands of people, supports logistics, or produces something the war effort needs. And Russia has already moved in that direction. In 2025, the Bank of Russia relaxed reserve rules for certain restructured corporate loans. The move was presented as a way to help highly indebted companies, including Russian railways. That may be reasonable policy in a stressed economy, but it also means some pain can be postponed. A loan that would normally force a bank to recognize more risk can be managed more gently, at least for a while. That is how a banking problem becomes invisible. It does not have to arrive as a line of depositors outside a branch. It can arrive as restructured loans, reduced credit growth, rising provisions, official reassurance, and companies that technically remain alive because recognizing the full loss would be too expensive. The Bank of Russia says the system has protection. On April 1st, 2026, the macroprudential buffer for consumer loans equaled 8.3% of that portfolio. The central bank also said accumulated buffers make it unlikely that delays in consumer credit turn into a threat to the banking sector. That is the official defense. The system has cushions, but cushions are not walls. They buy time. They do not erase the force pressing against them. The corporate side shows why this matters. In the small and medium-sized business sector, loans in the weakest quality categories rose from 5.9% at the beginning of 2025 to 7.6% on April 1st, 2026. That is not a banking apocalypse. It is something more useful to watch: the direction of travel. For large companies, the official numbers look better at first glance. The share of non-performing loans fell from 3.3% at the beginning of 2025 to 3.1%. But the Bank of Russia itself linked that reading to loan restructuring and slower recognition of losses. That is not the same as saying the problem went away. It means the accounting may be moving more slowly than the stress. And the stress is not evenly distributed. In 2025, large, highly leveraged companies expanded their debt by 16%, faster than the 12% growth of the corporate sector as a whole. Since March 1st, 2026, the Bank of Russia has raised the macroprudential add-on for growth in exposures to highly leveraged large companies to 100%. That is a technical sentence, but the meaning is simple. The regulator saw enough risk in lending to highly indebted large firms that it made such growth much more expensive for banks. That is not a sign of a system with no pressure. It is a sign of a regulator trying to stop the pressure from spreading. On July 1st, 2026, Sberbank's chief financial officer, Taras Skvortsov, said the bank would lower its forecast for corporate credit growth in 2026 because borrowers' financial condition had deteriorated. He said Sberbank was seeing worrying trends in the quality of its corporate portfolio. He also said loan restructuring requests would force the bank to increase provisions. That is not Western intelligence talking. That is Russia's largest bank acknowledging that corporate borrowers are getting weaker. VTB showed a similar direction earlier. It reported that the share of restructured corporate loans rose from 10% in October 2025 to 11% at the end of November 2025. At that time, VTB held 17 trillion rubles in corporate debt. 1 percentage point sounds small until it is applied to a balance sheet that large. That is the brutal math of banking stress. Small percentage changes become enormous amounts of money when the underlying loan book is measured in trillions of rubles. And the pressure is not limited to companies. Russian households are also showing strain. On April 1st, 2026, delinquency in unsecured consumer loans stood at 13.1%. It had risen 0.2 percentage point over the previous 6 months. At the same time, household debt in unsecured consumer loans fell 6% between October 2024 and March 2026, and the household debt service burden fell to 9.1% of disposable income on January 1st, 2026. Those numbers cut both ways. On one hand, households are carrying less unsecured consumer debt, and the official debt service burden is lower. That supports the Bank of Russia's argument that the system is not an immediate consumer credit crisis. On the other hand, delinquency is already high, and the European intelligence report said some large banks reported retail delinquency rates of up to 15% in 2025. A shrinking portfolio can still contain worsening loans, and outside the clean language of banking statistics, the social signal is harder to dismiss. In 2025, almost 568,000 Russian citizens were recognized as insolvent by courts, according to Fedresur's figures. That was 31.5% higher than in 2024. Reuters also reported more than 500,000 personal bankruptcies in 2025, almost one-third higher than the year before. More than 13 million Russians had taken on at least 3 simultaneous loans under state-encouraged programs, according to the European Intelligence Assessment. That is the household version of the same strategic pattern: credit keeps activity moving. It can support consumption, construction, and political calm, but it can also pull future weakness forward. Housing adds another layer. Mortgage delinquency rose 0.6 percentage point to 1.8% on April 1st, 2026. That is still far below unsecured consumer delinquency. But Russian households also had 1.5 trillion rubles in total obligations under real estate installment plans on that same date. Those obligations equaled 17% of the value of signed shared construction participation contracts. This is where banking, households, and construction meet. A mortgage problem is not just about a family and a bank. It can become a developer problem, a regional employment problem, a municipal revenue problem, and eventually a political problem. In a state-dominated war economy, failure is often delayed because too many people are attached to the structure, which leads to the case that explains the whole system: Russian railways. In November 2025, the Russian government was discussing ways to support Russian railways after the company accumulated 4 trillion rubles in debt. The company employed about 700,000 people. Its debt was owed mostly to state banks. As of June 30th, 2025, Russian railways had reported 3.3 trillion rubles in net debt, including 1.8 trillion rubles in short-term debt. That is a strategic asset, a national employer, a logistics backbone, and a borrower from state banks. Reuters described the case as a reflection of a state-dominated war economy, where companies too big to fail are indebted to state banks. That phrase, too big to fail, is familiar to Americans who remember 2008. But Russia's version is different. It is about a state economy under wartime pressure, where the same government needs the companies to function, the banks to finance them, and the budget to support the war. That creates a loop. The state needs the banks to support the economy. The banks need the state to protect them from the risks created by that support. The companies need both, and the war needs the entire loop to keep turning. Capital matters, liquidity matters, buffers matter. Chris Weafer of Macro Advisory gave the measured version of the argument. Russia's economy is stagnating, but the dominance of the state and defense spending mean there is no immediate financial crisis. No immediate crisis does not mean no strategic damage. By mid-2026, the macroeconomic picture was already tightening. On June 19, 2026, the Bank of Russia cut its key rate by 25 basis points to 14.25%. That cut was smaller than the 50 basis points analysts had expected. Russia's economy grew 1% in 2025 after growing 4.9% in 2024. It contracted 0.2% in the first quarter of 2026. In the first 5 months of 2026, the budget deficit reached 2.6% of gross domestic product, above the full-year target of 1.6%. Reuters attributed the overrun in part to increased military spending. The IMF projected Russian growth of 1.1% for 2026. Growth is weaker. The budget is under strain. Interest rates are still high. Corporate borrowers are asking for restructuring. Households are filing bankruptcy in rising numbers. State-linked giants need support. And the banks are expected to keep financing the system through all of it. The strategic risk is not that every Russian bank closes its doors at once. The risk is that survival becomes more expensive every quarter. Banks can survive formally while lending less freely. They can remain liquid while raising provisions. They can report adequate capital while carrying restructured loans that reduce future profitability. That is how a financial system turns into a storage facility for the cost of war. And once losses are stored there, the options narrow. Russia's banks may survive, but survival is not the same as strength. If the European intelligence assessment is even partly right, the banking system is not just financing the war economy, it is holding the losses the war economy does not yet want to recognize. The numbers are brutal because they do not have to predict a sudden collapse to matter. They only have to show that the bill is moving from the battlefield to the budget to companies to households and finally into the banks. And the longer that bill stays hidden, the more expensive it becomes when someone finally has to pay it. If you enjoyed the content, subscribe to the channel and watch our latest video.